Interest rates and return measurement explains the foundational relationship between interest rates, risk, and investment returns in financial markets. Interest rates represent the required rate of return demanded by investors, the discount rate used to value future cash flows, and the opportunity cost of consuming today instead of saving. The topic emphasizes that equilibrium interest rates compensate investors for delaying consumption and assuming risk. It introduces the concept of the real risk-free rate, which reflects time preference without inflation or default risk. In practice, observed market rates are nominal because they include inflation expectations and risk premiums. The topic further explains that nominal interest rates are composed of several elements, including the real risk-free rate, expected inflation, and various risk premiums. These premiums compensate investors for bearing additional risks associated with financial securities. Default risk arises when borrowers may fail to make promised payments. Liquidity risk reflects the difficulty of selling an investment quickly at fair value, while maturity risk measures the sensitivity of longer-term securities to interest rate changes. Securities with greater uncertainty require higher returns to attract investors. This framework helps analysts evaluate how risk characteristics influence bond yields and required returns across different financial instruments. The topic introduces holding period return, HPR, as a basic method for measuring investment performance over a specified time. HPR incorporates both income received and price appreciation during the investment period. For stocks, this includes dividends and capital gains. When evaluating returns over multiple periods, compounding becomes important because each period's return affects future growth. The topic explains that investment performance is commonly expressed through average return measures. The arithmetic mean calculates a simple average of periodic returns, while the geometric mean reflects compounded growth over time. The geometric mean is particularly important in finance because it measures the actual long-term growth rate earned by investors. Another important concept discussed is the harmonic mean, which is useful when calculating the average cost of investments purchased in equal monetary amounts over time. The harmonic mean often produces a lower value than the arithmetic mean because it places greater weight on smaller observations. The topic establishes the mathematical relationship among arithmetic, geometric, and harmonic means, showing that the harmonic mean is always the smallest and the arithmetic mean the largest when values differ. The topic also discusses how outliers can distort average returns and introduces trimmed and Windsorized means as methods for reducing the effect of extreme observations in financial datasets. The topic distinguishes between money-weighted and time-weighted rates of return, both of which are essential for evaluating portfolio performance. The money-weighted return is calculated using the internal rate of return, IRR, and incorporates the timing and magnitude of cash inflows and outflows. In contrast, the time-weighted return removes the effects of external cash flows by measuring compound growth across sub-periods. Time-weighted return is preferred for evaluating professional portfolio managers because managers typically cannot control investor deposits or withdrawals. Money-weighted return is more appropriate when the manager controls cash flows, as it better reflects the investor's actual experience. Finally, topic explains annualized returns, continuously compounded returns, and major return measures used in investment analysis. Annualization converts returns over different time horizons into comparable yearly figures. Continuous compounding uses natural logarithms to express returns and has the useful property of additivity across periods. The topic also differentiates between gross and net returns, pre-tax and after-tax returns, and nominal versus real returns. Real return measures the increase in purchasing power after adjusting for inflation. The topic concludes with leveraged returns, where borrowed funds magnify gains and losses relative to the investor's original capital, illustrating the impact of leverage on investment performance.